All right. Today is Thursday, May 20th. This is a recap for the stock market activities today. Yesterday, we talked about the market's interpretation of the FOMC minutes, whether the market will concentrate on the scope of more inflation before tapering, or will the market concentrate on the tapering. And I explained to you how the market will react in each scenario. But this is a process. We're not going to know that right away. It will take more time and more data for the market to decide whether to look at the half full part of the glass, where inflation will continue to rise higher, and therefore certain commodities and certain stocks will continue to outperform. Or will the market look at the half empty part of the glass, the tapering part, and the tapering part will be ugly for the majority of the market. In the meantime, the market will be dictated by the technicals, the oversold and overbought conditions. What do I mean by that? Here is an example. The RKK, this is ARK Invest, and it is the poster boy for the mania and the bubble. And therefore, when we have inflationary fears, you see the name leading the declines, and the name is way below the highs, down double digits. Yet looking at the chart, the daily chart for the RKK, and you want to pay attention to the RSI indicator, take a look at the oversold conditions in RKK. It is bouncing from the same level it has been bouncing from every single time. These oversold conditions have to be corrected, and therefore we see massive bounces from a daily perspective, anywhere from 2 to 5% in the RKK. However, looking at the weekly chart, the long-term perspective, the chart is not oversold, and the chart still looks weak, and therefore one must differentiate from the short-term perspective and the long-term perspective. In the short term, the daily chart, the oversold conditions have to be worked out, and that will be in the form of big bounces. And as a trader, you got to take advantage of that by playing the bounces via call options. On the other hand, one must not lose the longer term perspective from the weekly chart. And once again, as a trader, you can take advantage of that when the daily bounces reach exhaustion and reach resistance levels. You see the reversal in RKK turns down once again. You can also, as a trader, take advantage of that by closing your calls and switching to puts. This is the name of the game. Now, contrast that with the overbought conditions in the market. For example, here's a chart for Goldman Sachs, a name that I happen to own in my portfolio. And it is the kind of name you want to own in this environment of higher interest rates and more inflation. However, the weekly chart, the long-term perspective, the chart looks overbought and overextended. Looking at the RSI and the MACD indicators. Matter of fact, the move looks vertical, and we know that charts don't go in a vertical line without corrections. The clearest illustration of that is the mania names, the likes of Plug Power, etc. And the recent correction in commodities, by the way. Case in point, lumber. And these overbought conditions in the longer term charts, they get corrected in the daily charts. Here is a daily chart for Goldman Sachs. The chart is no longer overbought from a daily perspective. And you see these small haircuts, down 1%, down 2%, then up again, then down again. And you work out these overbought conditions on the weekly charts by taking small trims in the daily chart. Once again, working out oversold conditions in the short term, the daily charts, happens via massive bounces higher, anywhere from 2 to 5%. Working out overbought conditions from the longer term charts, the weekly charts, takes place as small trims in the daily chart. Here is another example, the MTUM ETF. This is the momentum ETF. Here is a daily chart. We have, or we had at least, oversold conditions, and you can see that clearly from the RSI indicators. Every time the chart goes down to that level, it bounces higher. However, looking at the weekly chart for the MTUM, the momentum indicator, we have a semi-double top formation, and the chart is not oversold at all. Matter of fact, we have a loss of momentum from the MACD indicator, failing to cross to the positive territory because the momentum in the momentum ETF has been already exhausted. What does that mean? You can see bounces in the short term, but in the long term, the weekly charts, there is lots of weakness for the MTUM. And unless and until the chart starts to make repairs on weekly basis, the the bearish outlook in the long term remains on the table. Now, contrast that with the weekly chart of the VTV, the value ETF, overbought conditions on the weekly chart, the longer term chart. These overbought conditions will be worked out by small corrections on the daily charts, and the process will be gradual. And all in all, these small daily corrections at the end of the day could amount to a sizable correction, perhaps going back all the way to the support of the Fibonacci retracement level. I hope that this is not confusing, by the way. And if it is, ask questions. I think I'm being clear here. In the short term, we have oversold conditions in the market. In the NASDAQ, the tech names, the mania names, these oversold conditions have to be corrected, but the weekly charts for these names remain bearish. On the other hand, for the value names, the inflationary names, we have overbought conditions on the weekly charts. Those have to be corrected by making small corrections in increments in the daily charts, the short-term charts. Now, the question is, what happens after we work out all of these oversold and overbought conditions? What happens after the technicals are already corrected? And by the way, certain charts have been already corrected. The oversold conditions are already corrected. It happens very fast. Correcting the oversold conditions, that is, correcting the overbought conditions, takes a little longer, because once again, the overbought conditions are happening in the weekly charts, not the daily charts. So what happens after all of that is corrected? The market will look at the fundamentals, the monetary policy, and the macroeconomics outlook. And in the morning, we received more macroeconomics data, the Philly Manufacturing Index, and here it is. On paper, the Philly Fed Manufacturing Index actually cooled off, and it fell to 31.5 in May from nearly 50-year highs in the prior month. And right away, the inflation deniers started to cream their pants. Matter of fact, I heard on CNBC, and they were saying that perhaps the Fed, led by Papa Jerome, are right about inflation. And perhaps it is transitory because the Philly Fed manufacturing is cooling off. But here is the catch. You and I are looking at the prices paid. We're not looking at the economic activities index, because we know that this is a cocaine-fueled recovery, meaning it will result in inflation, but it will not necessarily result in a prolonged recovery in the economy. And that, by the way, will lead to a phenomena called... Oh, wait a minute. We're not allowed to say it, remember? Because last time I said it, I got banned from YouTube. Shh, keep it down. You're not allowed to say it, but you know, we're talking about stagflation. And that could not be more evident from the prices paid in the survey. The prices paid index rose 7.7 points to 76.8 in May. It is the highest level since March 1980. The prices received index rose 6.5 points to 41, the highest level since 1981. But hey, where is inflation? Is it here? Is it there? I don't see inflation. Papa Jerome says there is no inflation. The media tells me there is no inflation. Meet Kevin tells me there is no inflation. Mama Kathy tells me there is no inflation. Okay. The Philly Fed survey shows the highest price gauges since the 1980s. Supply chain bottlenecks, mounting wage pressures, and soaring material costs are testing profit margins, prompting companies to increase their prices. A special question in the survey showed firms will raise their prices 5% over the next year, up from a February projection of only 3%, and flaming concerns about the inflationary pressures bubbling across the economy. But hey, where is inflation, right? And here is the price projections. And you can see that month over month, the projections increased from 3 to 4 and 5%. This has become an extremely alarming situation. The Fed says, oh, we don't see inflation. It's not at 2% where we want it to be. Meanwhile, the inflation in prices paid and the prices that will be passed all the way down to us, the end customer. If the increase in prices is projected to be 5% next year for the producers, then the price increase for us, the end customer, will likely be 8 to 10%. If not higher. But hey, where is inflation? I don't see it. Is it here? Is it there? And of course, some donkeys continue to say that the risk is actually deflationary. Are you blind? deaf, or just stupid. Anyhow, the other piece of news that we got today in the morning is regarding cryptos. You know, cryptos had the flash crash. Some managed to bounce higher, some not all the way, but the pressure is mounting because the US Treasury is looking to register any crypto transaction over $10,000. Uncle Sam wants his piece. And this dark world of cryptos, filled with crime and extortions, use your head. You really think the government is not going to crack down on cryptos? Think again. And we also got more pressure against cryptos from the Federal Reserve because the Fed might not be thinking about tapering, but it is thinking about the digital dollar. And if they are seriously considering issuing a digital dollar, then goodbye to cryptos. And that will be a happy day, by the way, because we will get rid of all the scumbags, the scams in the comments, the filth, all of that will be gone. We might hear the piggies squealing for a little while, but they will be gone. It's over. It's done. But hey, man, why are you siding with the Federal Reserve? Why are you siding with the government? Side with the people. Crypto is the people. The new currency. We're challenging the US dollar and the worthless fiat currencies. Really? Your so-called stable currency, the hedge against inflation, falls down 30% in a flash crash in a single day? That's the stable currency I should believe in? That's the replacement for the worthless fiat currencies? Or is it just a tulip propped up by speculations and pumpers and stupidity? Anyhow, we will talk about that and a lot more in the coverage of this program. But for now, let's cover the market performance today. And here we go. The Dow Industrial Average closing in the green by 188.11 points, or a gain of 0.55%. The Nasdaq leading the day with gains of 236 points, or 1.77%. The S&P 500 also closing in the green by 43.44 points, or a gain of 1.6%. And notice the relative volume in the blue meter. The volume was way below the average, and the market likes that because in days with lower volume, the path of least resistance is higher. There is no selling pressure. What about the sector's performance? Leading the pack at number 1, capturing the gold medal, technology. At number 2 for the silver, communication services. At number 3 for the bronze, healthcare. Every single sector of the market managed to close in the green, so we're not going to shame any sector. What about the advance to decline ratio for the NYSE? 62% advancing versus 35% declining. The Nasdaq 70% advancing versus 27% declining. All in all, a decisive day in the green, but you have to combine that information with the volume. We had a very low volume kind of day. Relative volume, not actual volume. Moving on to futures. What's going on here? Declines for crude oil, the WTI, and Brent. The situation over in Asia, specifically India, is not improving at all. Matter of fact, India registering the highest death toll in the pandemic. The daily death toll, that is. And therefore, that is throwing cold water against the so-called global recovery and the global recovery in the demand on oil specifically. But once again, you have to differentiate between actual demand and other factors behind the rise in commodities. Commodities rise based on supply and demand, but they also rise as a result of the cocaine operation. The liquidity tsunami, the money supply, that money has to go out and chase assets. And when money realizes that inflation will rise higher, that money chases commodities, including oil. What about softs? We have a recovery here for lumber, and here is the story. U.S. lumber futures jumped for the second straight day, Thursday, as signs of demand held strong. The mania is not over yet. It will not be over until the Federal Reserve starts to raise interest rates. And according to their plan for now of inaction and not thinking about, inflation will get out of hand. If inflation gets out of hand, commodity prices will continue to rise higher. We will see steep corrections, but at the end of the day, inflation always is a monetary phenomenon. It all goes back to the cocaine operation and the money supply. So long as that's still going on, inflation will continue to rise higher, pushing commodity prices also higher. We also saw massive gains for OJ futures. Meanwhile, declines led by cotton and cocoa futures. Meanwhile, coffee and sugar futures remained muted. What about metals? Muted activities across the board, but notable losses for copper and palladium. Copper is experiencing a correction, and I showed you the chart, perhaps going to the trend line and then bouncing higher. For now, that is the destination and the outlook. What about meats? You might have corrections in lumber and copper, even corn, but not the piggies, because the demand for the piggies is sky high. Meanwhile, the supply remains extremely low. But perhaps after Bitcoin crashes entirely, once and for all, we will have an abundant supply of piggies who got slaughtered, and the meat is ready to be exported to China, and therefore lean hogs will become a short. Anyhow, we saw a pullback for feeder cattle futures. Meanwhile, live cattle futures remain muted. What about grains? We have a modest rebound for corn futures. Meanwhile, declines for soybean oil futures. The rest of grains futures remain muted with exception of oats. Oats rising higher. We had the IPO of Oatly. That was a successful one, pushing oats futures higher. My oats play is SunOpta, not Oatly. I like SunOpta a lot more. The valuation is more reasonable, and SunOpta is more diversified. In addition, it is the supplier of oat milk to other companies. It is a bullet stock. If we have an oat milk craze in the country, SunOpta benefits regardless. Moving on to the big casino, the options market. What's going on here? We have a slight recovery in the volume. But remember this, the Nasdaq is struggling to rebound higher and start another rally. And the reason is the absence of gamma. What does that mean? It means that the Nasdaq was surging higher since last year based on gamma squeezes and the activities in the options market. Once the retail traders got slaughtered, we're not seeing the mania anymore of chasing call options. All of a sudden, the Nasdaq is struggling to form a rally. But perhaps there are some signs for life here, because Apple, leading for the day and registering over 1 million contracts, about 65% of those were calls. Apple was trading below 1 million for the last few days. We're starting to see some recovery here, and you are seeing Apple pushing higher. What about Tesla? At number 2, with a little over 700,000 contracts, about 59% of those were calls. We talked about the fact when bears, the Johnny-come-lately bears, start to pile in against Tesla and buy put options aggressively. And I told you that would be a sign for a bottom. And this is exactly what's going on with Tesla, at least a short-term bottom. What about AMD at number 3, with a little over 500,000 contracts, about 74% of those were calls. We have a lot of buying in call options for Ford because Ford announced the new truck, the new electric truck, the F-51, and it is getting excellent reviews, and the demand remains extremely high for the pre-orders. They're already sold out of the Mach-E, and they're going to be sold out for the new Lightning electric, whatever pickup it is. And we are seeing excitement here in buying call options for Ford. Now, I happen to own the name, so I am taking advantage of the elevated premiums for options by selling upside calls. Another name that caught my eye is UPS. UPS, with about 98% of the total option volume traded today for the name, were calls. Usually when we see blue chip names trading at 97, 98% calls, that is usually a sign that the stock will go down in the next few days, not up. I say usually, not always. What about the unusual trades today, starting with the ticker ARKKKGOS for Tesla witch Cathie Wood? Now, remember this, when we saw elevated put options volume for RKK, trade after trade after trade, I told you this could be a sign for a bottom in RKK. Now we will see bounce chasers. I showed you over the weekend the oversold conditions in RKK, suggesting that we are about to see a big bounce in the name, and that is already playing out. Now the Johnny-come-lately bulls will start to pile in buying RKK calls. That will be a sign for a top and a reversal. So you gotta watch the options volume extremely closely. I'm not saying we are there, because the call options volume for RKK is still not elevated. But all in all, I am seeing elevated call options volume attempting to chase oversold bounces after they have already started to play out. So we will see the Johnny-come-latelys chasing these oversold bounces. That will be the top right there. But for now, here's the trade. They're buying the 114 calls. Expiration date June 4th, and pay attention to the short-term plays. They're not expecting RKK to rise higher in August or September. They're playing a rebound, and they are expecting the name to rise over 7% by then. That is June 4th. They paid about $1.20 a piece to enter this trade, and that brought the total all the way to about $2 million. What about the trade for the ticker AMD? They're buying the 82 calls, expiration date June 4th, with expectations that the name will rise over 5% by then. They paid about 85 cents a piece to enter this trade, all in all bringing the total to about $1.4 million. What about the ticker TQQQ? This is the inverse of the SQQQs, meaning if you want more leverage betting in the upside for the Nasdaq, you buy the TQQQs. And once again, they're noticing the oversold conditions, they're noticing the bounces in these names, and they're trying to capitalize on the gains before the bounces are over. And in this case, they're buying the 107 calls for the TQQQs, expiring June 4th, with expectations that the name will rise over 8.5% by then. They paid about $1.25 a piece to enter this trade. All in all, bringing the total to about $1.3 million. What about the ticker FTAI? This is for Fortress, and this is an infrastructure play, by the way. They're buying the 31 calls, expiration date July 16, with expectations that the name will rise over 11% by then. They paid about $1.10 a piece to enter this trade. All in all, bringing the total to about $1 million. What about the trade for the ticker MA for MasterCard? They're buying the 395 calls, expiration date June 18th, with expectations that the name will rise over 7% by then. They paid about $1.75 a piece to enter this trade. All in all, bringing the total to about $1.5 million. What about the trade for the ticker SPCE for Virgin Galactic? You know, the fraudster, Chamath, Predatoria, who preyed on all of these morons, the SPAC generation. Oh, but you don't understand, bro. Chamath is the future. SPACs are the future. Really? They're entities designed to make money out of you, not for you. Enough said. And Chamath walks, making more money than he ever made. Meanwhile, these donkeys are holding the bag. But perhaps the name is also bouncing off oversold conditions, and somebody wants to hop on the ride higher. To space, bro, to the moon. By buying the 21 calls, expiration date May 28th. Not a lot of time left for this one. And they are expecting the name to rise over 6% by then, and they paid about $1.65 a piece to enter this trade. All in all, bringing the total to about $1.4 million. What about the trade for the ticker IWM, the Russell 2000, underperforming the market today? All indices, Dow Jones, Nasdaq, S&P 500, all closing in the green decisively. Absent in that picture, the Russell 2000. And by the way, you have a lot of technical analysts who see the IWM as a leading indicator for the rest of the market. Anyhow, they continue to pile in against the IWM by buying the 206 puts, expiration date June 4th, with expectations that the name will drop over 6% by then. They paid about $1.10 a piece to enter this trade. All in all, bringing the total to about $880,000. What about the trade for the ticker GMIA, Jumia? This happens to be one of the retail crowd's favorite names. Africa's the future, bro. Really? Have you even been there before? Do you even know what Jumia does over there? Or did some YouTuber, influencer, TikTokers spit the ticker for you and you chased it like a donkey? You fell in love with the name and now you're holding the bag. Join the club. But anyhow, here they're betting for more pain for Jumia by buying the 23 puts, expiration date June 18th, with expectations that the name will drop over 17% by then. They paid about 90 cents a piece to enter this trade. All in all, bringing the total to about $550,000. Moving on to the heat map analysis. What's going on here? The entire roulette table is lighting up green, meaning that if you placed your bets anywhere in the table, with very few exceptions, you managed to score, but specifically in the high multiple mania names and the technology sector. Meanwhile, the inflationary trade of financials, industrials, energy, materials, underperforming today, but yet without any massive losses. You don't see that mass exodus out of the inflationary trade. And once again, I heard a genius over at CNBC today saying that perhaps we're seeing a rotation off the rotation from the inflationary trade to the deflationary trade of technology in high multiple names. Really? These are supposed to be the experts, by the way, and they sit around every day watching the charts tick by tick with a big jar of lotion, jerking off to every green candle. You're talking about 1 week of overperformance from the deflationary stocks and underperformance from the inflationary stocks. And that's it. We're done. We're rotating out of the rotation. Why? Did the macroeconomics outlook change? Did the monetary outlook change? Of course not. Or perhaps what's going on is due to technicals and overbought and oversold conditions. And by the way, the volatility in the technology sector, up or down, is extreme because it is tied to the daily chart narrative. Meanwhile, the overall volatility for the inflationary trade is extremely tamed. And the reason is, when it comes to the inflationary trade, it is a weekly chart story, fixing those overbought conditions from a weekly perspective. Therefore, you're not going to see massive moves on daily basis, unlike the oversold conditions from daily basis in the technology and the high multiple names. What about the themes analysis, starting with the reopening trade? Still muted, we're seeing losses here and there, mixed picture, and once again, the majority of these names already reported earnings, and the bulk of the gains already made. The risk here is for sell the news once the reopening happens, and these names are highly dependent on the success of the so-called pent-up demand and the upcoming splurging in the economy. But you have to pick your reopening trades carefully. You have to be picky within the reopening picks. For example, perhaps the gains for hotels and casinos have already peaked because some of these names already trading above the pre-pandemic highs. On the other hand, the airline sector and the cruise ship sector have yet to recover the pre-pandemic highs. It's not going to be an easy job, but if you are chasing momentum in the market, pretty much everything is overvalued and trading above the pre-pandemic highs, with very few exceptions in the airlines, cruises, and certain reopening names. For example, Cody. These names are beaten down severely, and if the money will continue to chase the reopening names, it will perhaps flow into these names, not the names that have already recovered the pre-pandemic highs. Enough said. Moving on to the inflationary trade. What's going on here? All in all, we have a positive picture, but we saw massive declines yesterday. Was that it? For example, a name like Alcoa, the ticker AAA. The name is down 10% yesterday and down another 1% or so today. At some point, it will also become oversold and it will start to bounce higher. For now, all of what's going on is fixing the overbought conditions on the weekly charts. At some point, doing so will make the daily charts in the inflationary names, in this case Alcoa, to become oversold, and we will start to see bounces, big ones, in these names. And perhaps by that time, when Alcoa becomes oversold and start bouncing, a name like RKK will become overbought from a daily chart perspective, and you're going to see the long-term outlook, the bearish one, from a weekly chart perspective, playing out once again. ARK reverses down, Alcoa reverses higher. You see how smart I am? What about the disinflationary trade? Here it is, green across the board with very few exceptions. Once again, playing those oversold bounces, and those oversold bounces, by the way, create big gains in a short amount of time. The bounces are 2 to 5%. Therefore, it is a trader's heaven, specifically for swing traders. And if you missed the rebound higher, rest assured you're going to catch them when the reversal happens again to the downside. This is trader's heaven. All you have to do is follow the technicals and you're going to score big. Speaking of, moving on to the charts analysis, starting with 30 minutes chart of the SPY. We have the double bottom formation from the level of 406. That played out in an aggressive rebound higher, recapturing 412, the most important level of support, but stopping short of recapturing the support of 417.30. But we're not going to make a big deal out of it because the move is already parabolic and it has already achieved the most important goal of recovering 412 for support. Because in the event we see a reversal tomorrow, the level of 412 will act as strong and sticky support. The assumption is tomorrow is the end of the week, Friday, so the volume will be low, and that should enable the SPY to complete the job and go all the way and recapture 417.30 for support. The problem is that tomorrow also happens to be OPX, options expiration, and therefore we will see more volatility compared to a usual Friday. Zooming out to the continuous contract of the SPY, we talked about an ABC pattern, and that is not looking likely from the previous two candles. The S&P 500 has a different pattern in mind, and that will not be clear to us until we see the weekly closing candle tomorrow. That makes tomorrow an important day because building on the previous two candles with another green candle will change the perspective entirely for the upcoming week. However, reversing, let's say we have option expiration, and we have more volatility than usual, and we see another down day for the SPY, then that will keep the bearish outlook on the table. That perhaps the correction is not over for the SPY, and we will see the charts going all the way down to 3,960. For now, the negative divergence in the RSI is still here. In addition, the negative momentum in the MACD indicator is still here. We are not seeing a significant curling upward in either indicator. Here's another way to illustrate the importance of the candle we're about to receive tomorrow. We have a wedge consolidation, and the breakout out of the consolidation is imminent. It could happen as soon as tomorrow. Matter of fact, as soon as tonight, because this is a continuous contract chart. What about the Qs? 30 minutes chart, what's going on here? We talked about the big bounce from 317. Not once, not twice, but this is the third time the chart is bouncing off 317. Now, the ideal scenario was for the Qs to build on the gains from yesterday during the trading hours, not on the heels of an overnight gap higher. Anyhow, the Qs managed to recapture two important support levels, the 323 and the 326. And therefore, even in the event of a down day tomorrow, the triple Qs has plenty of support behind it from 326, 323, and 317. And by the way, the next destination for resistance is 330 and a half. The problem is, from a 30 minutes perspective at least, is that every time, at least recently, the RSI from a 30 minutes perspective reached that level, we saw a pullback. So if the pattern holds, we are supposed to see a pullback in the Qs tomorrow, perhaps going all the way down to 326, and we will take it from there. What about the daily chart for the continuous contract for the Nasdaq? We have repaired a lot of the damage from a daily chart perspective at least. Number one, we had the hammer candle, and that enabled another bullish candle, recapturing 13,300 for support. That is achievement number one. Achievement number two, the chart is becoming extremely close to reverse the negative divergence in the RSI. Furthermore, the MACD indicator is curling upward. If we have a successful crossing in the next few days, trading days, then the MACD indicator will start to register green impressions on the histogram, indicating that we have positive momentum building up for the Nasdaq, and you'll know right away, well before that the bottom is already here, and the chart is looking forward to make higher highs. The problem is, how would the Nasdaq make higher highs without the participation of the mania names? Is it going to make higher highs based on the outperformance from big cap technology stocks? For example, we don't have a problem with Facebook and Google. The problem is in Apple, Microsoft, and a little bit with Amazon, but mostly with the smaller cap names, the software names, chip names, mania names. Without the participation, a wholesome participation of the various sectors in the Nasdaq, it is unlikely that the chart will make a higher high. And by the way, here is the NDX, the big Nasdaq. We have a consistent pattern, at least for the last 3 weeks, where the market underperforms during the earlier part of the week, Monday, Tuesday, Wednesday, and then Thursday and Friday, the market rebounds higher. And I am highlighting this for you on the chart. Last Thursday and Friday, we saw upside days. The week before, similar story. We're starting to see 2 days in a row of upside activities in the Nasdaq. Wednesday and Thursday. Will Friday follows the same pattern, or will the action tomorrow breaks the pattern with the last couple of weeks? This is what I will be watching for tomorrow. What about the IWM? Small caps lagging, underperforming today, rebounding higher, recapturing 218 for support, closing the gap, but that's about it. We ran out of time. And the question remains, will the IWM build on the bounce, trade above the gap, and recapture the next support, now resistance level of 223? It's a long shot, but it is possible. The problem is if the IWM starts reversing tomorrow, closing the gap and then reversing down, that will be an ominous signal that there is not enough fuel in the tank for the IWM to surpass this level. Zooming out for the daily perspective for the RUT, the Russell 2000. Once again, the bears have the advantage for now, but we are waiting for the weekly closing. It has been a battle back and forth with no definitive conclusion. The assumption is tomorrow the weekly closing will also be another indefinitive closing because it will take a massive pop higher for the chart to close weekly above 2,264. Likewise, it will take a massive down day to close below 2,100 and give the bears the advantage once and for all. The likelihood is the Russell 2000 will keep us on hold. What about the Dixie? What's going on with the dollar index? Going down today. We saw a mini pop higher from the FOMC minutes. That lasted for 1 day and the chart is reversing lower. Now we have a unique candlestick pattern. Remember the hammers from yesterday for the Nasdaq? That played out to the upside. Now we have a sandwich stick pattern. And in a sandwich stick pattern, the candle in the middle sandwiched by 2 candles. In this case, a green candle sandwiched by 2 giant red candles. In this pattern, the candle in the middle will play out, meaning the green candle, meaning that the US dollar will rise higher. And once again, I am not a big believer in candlestick patterns, but they do play out once in a while. Here is my take, however. The US dollar, the weekly closing, has to be definitive. Either you're going to close above 90 and that will signal more upside for the US dollar in upcoming weeks, or closing below 90 for the week will signal opening the floodgates for the US dollar in upcoming weeks, because the level of 90 happens to be critically important. You cannot close the week below 90. You hear that, Mr. Powell? What about gold? What's going on here? From a daily chart perspective, it looks overbought, and it looks that we are nearing a short-term top in gold. However, switching to the weekly chart, and as you can see, the rally just started in gold. We had a descending line of consolidation that has already been broken to the upside. We are seeing positive divergence in the RSI and a positive crossing in the MACD indicator, signaling that the positive momentum in gold has just started. Remember when we talked about the overbought conditions in the value and inflationary names from a weekly perspective, and the remedy to repair that is small haircuts in the daily chart. Now, what happens in the opposite situation? For example, gold, where the daily chart is overbought. Meanwhile, the weekly chart is recovering from oversold conditions. The remedy is big down days from a daily perspective to fix the overbought conditions. But all in all, these will be blips from a weekly perspective, and the assumption is that once the overbought conditions from a daily perspective are fixed, the weekly chart will persist and we will see a rebound higher for gold once again. The weekly charts hold more weight than the daily charts. Moving on to yields. What's going on here? The 10-year Treasury yield popping higher after the FOMC minutes, taper or not taper. paper to think or not to think, yields popped higher. And we know that so long the trajectory for inflation is higher, the trajectory for the 10-year Treasury yield will also be higher. We have a lot of funny business happening in the meantime. Lots of foreign buying of bonds and lots of buying from the Fed. Whether they want to admit they're already practicing Operation Twist or not, the facts don't lie. They've been buying more than scheduled, pushing yields artificially lower. Eventually, you're gonna have to face the music. Yields at the mercy of the support level of 1.622 basis point. Breaking that support once again, and the chart will likely go down all the way to the levels of 1.557 basis point. But the support is strong for now. It has been tested once, twice, and this is the third time in the last few days that this support level is being retested. What about the TLT? Bond prices, we're watching the weekly chart. For now, no definitive conclusion one way or the other. But the bears have a slight advantage here. Breaking 134.5, the bears have a complete advantage. Closing above 134.5, the bulls live to fight for another day. The battle goes on. The TLT is starting just slightly to gather some positive momentum, but it is still extremely weak in the grand scheme of things. What about the VIX? What's going on here? The VIX has plenty of momentum behind it from the RSI and MACD indicators. The problem for the VIX is it is struggling to break above the resistance level of 25. The challenge is, from a weekly perspective, to hold above 20. That will be good enough for the VIX to keep the outlook that the VIX will pop higher once again in upcoming weeks. But if we close below 20 once again tomorrow, then the weakness will become evident in the VIX. And by the way, the mirror image of the VIX, the SPY, if the VIX closes below 20, the SPY will close so close to all-time highs, suggesting that the correction in the SPY is over, and here comes all-time highs once again. Therefore, the weekly closing tomorrow is extremely important for the VIX. And by the way, the weekly chart of the VIX is suggesting that the action hasn't even started for the VIX. This was a warm-up, and the big show is coming soon. And of course, we will review the weekly charts over the weekend. Moving on to Apple, what's going on here? Bouncing higher overnight and recapturing the very important level of support of 125. It also happened to close the prior gap last time around, failing to close that gap and reversing lower, opened the floodgates, and the 125 level of support was violated. For now, the chart closed below the gap by a few cents. We're not going to make a big deal out of that, but all in all, recapturing 125 for support, check mark number 1, check mark number 2, closing the prior gap. The problem is the area between the support level of 125 and the resistance of 131 is pretty much an open field. There is very few soft resistance and support levels. What does that mean? It means that the center of gravity starts to hold control over the chart. Where is the center of gravity? 120. To defeat the center of gravity, you gotta recapture two support levels above the center of gravity. In this case, recapturing 125, but the next support level is 131. Absent of recovering 131, and the possibility for going down all the way to 120 is still on the table. Moving on to the souffle. What's going on here? The souffle is rebounding higher, and it is rebounding without me because I've been conservative. My number is 540. The chart went down to 546, 545. And rebounded higher. You see the oversold conditions in the RSI, the name bouncing higher, but you know the story. The weekly chart, the long-term picture charts are still bearish, meaning Tesla could rebound higher, fixing the oversold conditions from the daily chart perspective, but fixing the bearish outlook from a weekly perspective, that is a very difficult job, pretty much close to impossible. The weekly chart has to play its way, meaning that the weekly chart has to become oversold too before Tesla reaches a reliable bottom. We have a long way to go on the weekly chart before it becomes oversold. Therefore, in the immediate run of the daily chart, which happens to be oversold, the name bounces higher until it reaches a resistance level and we no longer have oversold conditions, and right away you're going to see a reversal of that rebound. So once again, as a trader, you could play the rebound higher. You could also wait and play the reversal. Where is the level of resistance here from which we might see a reversal of the bounce you're seeing right now? My number is 629. Moving on to tulips. What's going on in the tulip mania market? Bitcoin recovering all the way to the very important level of resistance, former support of 42,000. For now, the chart is failing to recover 42,000, but looking at the RSI, we still have oversold conditions. The problem is that Bitcoin got a double whammy from the announcement from the Treasury Department today and the Federal Reserve. So the negativity in sentiment is still here. But who has control over this chart? Is it the hodlers? Of course not. The hodlers are just holding. They already borrowed on margin and they are looking at the chart anxiously. The power is on the hands of those who bought the dip yesterday. Some of these people are up 40% already. What are they going to do? Are they going to book the gains? You know, exchanging those precious bitcoins to that useless fiat currency called the US dollar? Or will they also become hodlers? And if they do, then Bitcoin could actually recover 42,000, assuming new blood will start buying Bitcoin at this point and assuming that those who bought the dip at 30,000 will continue to hodl. What about Doge? Doge not looking so hot, so it is not oversold, unlike Bitcoin. And of course, Doge moves based on the tweets of Reverend Elon Musk. So if you are investing in Doge, you are a tweet-based investor. You're waiting and waiting and waiting for Reverend Elon to start pumping via tweet. And this morning, we got a tweet from Reverend Elon doing a Reddit, find the Doge or whatever, that was good enough to pop Doge higher. This is how these people are investing. They're borrowing on margin from Robinhood and Webull, etc. They're using their life savings to buy Dogecoin, putting all their faith and belief on one man who's, by the way, a selfish, egotistic maniac who doesn't have your best interest in mind. We're going to see a slaughter here. Doge will crash, and we will see stories like you've never seen before of people who took loans against their homes, used their student loans, the life savings to buy Doge, believing in the magic of Reverend Elon Musk, only to be surprised that they have invested in a tulip and they have lost all of their money. You want to invest in a tulip chasing momentum? That's okay. That's opportunity. This is what you're supposed to do as a trader. But be man enough and a woman enough to admit that you are investing in a tulip that you do not understand, and this tulip happens to have zero intrinsic value. And therefore, you're going to trade this thing. You buy it, you see the pop, you sell, and you're out. You made your VIG. In, out, hello, goodbye. What about ETH, Ethereum? What's going on here? Massive sell-off and a recovery all the way to the critical level, 2,900. The critical level for Bitcoin is 42,000. The critical level for ETH is 2,900. They're all going back to the same level, facing that resistance. I understand that they're all going to be trading hand in hand, but BTC is oversold, ETH not so oversold. So if you are chasing a bounce, pick BTC over ETH. I hear that BTC smells a little better. You know, the tulip smells a little better than ETH, at least for now, this season. And by the way, before we move on to the conclusion of the video, I want to share with you the chart for the S&P 500 buybacks. There is a false narrative out there saying that so long that corporate America, S&P 500 companies, NASDAQ companies, NYSE companies, it doesn't matter. So long as they're spending an enormous amount of cash in share buybacks, the stock market will not go down. The problem is that this is a false narrative because share buybacks will also peak. And last time we saw share buybacks peaking, that was in 07-08, preceding the financial crash. Nowadays, we're also seeing that buybacks are rolling over, perhaps signaling a peak cycle in buybacks in certain sectors of the market. And by the way, if you want to chase the buyback narrative, take a look at this chart. Is the opportunity in technology and communication services where buybacks are already at all-time highs? Or is the opportunity in chasing the recovery of share buybacks in financials and industrials? Share buybacks are bottoming for financials and industrials. We know that the moment the Federal Reserve allows big banks to resume share buybacks, you will see a tsunami, billions and billions of dollars, buying back stocks in the financial sector. And as we see inflation inflation continues to rise higher, you will start to see the share buybacks in industrials also resuming. So once again, is the opportunity in technology where buybacks are already peaking, or is the opportunity in financials and industrials where buybacks are just starting to recover? Keep that thought in mind. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the manufacturing and services PMIs. Very, very important reading. We got the Empire State Manufacturing Index. We got the Philly Manufacturing Index. Both of these indicating that the prices paid, the price indices, are at the highest levels since 1980. Will the manufacturing and services PMIs confirm the Empire and the Philly manufacturing indices where we saw more signs for inflation? Lastly, what about the earnings calendar? We have an important name, Deere. You already saw profit taking ahead of earnings. And once again, if earnings are disappointing because the stock is pretty much trading at all-time highs, if there is a slight disappointment in the outlook, forget the revenues, forget the net income. It's all about the outlook. If the outlook is not as favorable as the chart is suggesting, then you will see a massive, nasty flush down in Deere. However, if the outlook is still intact, then the sell-off has already happened prior to earnings, and you will see Deere bouncing higher. Why is this important? Let's say that Deere bounces higher tomorrow, and we see futures also rising higher in terms of commodities. That will shoot down the bullshit narrative that I heard today that we are seeing a rotation of the rotation from the inflationary trade to the disinflationary trade. And these geniuses, of course, not paying attention to the technicals at all, but somehow they get a spot on TV. Anyhow, that's all I got for you tonight. I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.